Ishaq Siddiqui is with us, market strategist at ETX Capital. Ishaq, great having you with us. It seems to be a case where the markets need one or the other factor to worry about. Till about last week and the weeks before that, it was all about the QE taper. Now, it seems to be a case of the US debt ceiling. How big is the issue, and what are the implications for global financial markets?
Yeah, I think the debt ceiling issue itself is slightly somewhat overblown in the market because we really weren't really too concerned about it until Fed Chairman Ben Bernanke last week suggested that was one of the reasons why the Fed held back from tapering asset purchases. So obviously, if the Fed sees it as a big talking point, the market now started to realize that this may be a potential stumbling block when it comes to U.S. economic policy. I think U.S. lawmakers will do what they do best, and that's kicking the can down the road again, and they're not going to be able to tackle the actual issue just yet, and it seems like they'll probably delay it until 2014 and perhaps come up with a way that all can reach some sort of reconciliation to raise the debt ceiling. But there's still massive polarization in U.S. Congress between the Republicans and the Democrats, and it's unlikely that they're going to be able to be unified in their approach yet. So I think it is a particular concern for the market, but I think more so than that, we're really just trying to figure out when the Fed will start tapering asset purchases. Are we going to see maybe some sort of tapering next month, or are we going to have to wait until the end of 2013 before Ben Bernanke fires the first round of tapering? It's going to be interesting because he is leaving the Federal Reserve, and one would think that he should initiate the first round of tapering in order to get the ball rolling.
But has the issue of a QE taper completely died down? I'm quoting a report which appeared in Bloomberg, which suggested that St. Louis Fed President James Bullard apparently said that a small tapering of bond purchases is possible at the Fed's October meeting. Do you think that threat is still on us?
Absolutely, yeah. I mean, look, I don't think the narrative's changed. I think more so than anything else, what's really kind of changed is the way the market is now starting to see, or the perception of the Federal Reserve. We know that tapering is going to happen. It really is a question of when are they going to do it. We're expecting them to start tapering this month. The fact that Ben Bernanke backtracked a little bit, he put the onus more on inflation as opposed to the unemployment target, and also in many ways it seemed like he was making up monetary policy on the fly. He has lost a degree of credibility in the market. I think the market is going to be less likely to trust what the Federal Reserve had to say this time around, because they almost convinced us through their language and certain remarks by Federal Reserve members that they are looking to taper quantitative easing in September. However, they did not, and now I think the market is looking to just gear itself up for some sort of tapering in October. It's very difficult when it comes to the Federal Reserve because of the ambiguity in the language that central banks have to put out there. So I don't think that's changed in any way. I think the market right now is really just latching onto anything it can. We have the German elections on Sunday, and it seems like no change to the status quo, so that's welcome relief for the market. Today, really, the focus is on the PMIs that we're coming out with, that we're seeing from China and the Eurozone.
The Eurozone composite PMI is at a 27-month high. Does that mean that the worst is behind for the Eurozone economy?
I don't think so. I think, the number itself, today's PMIs, they were slightly weaker than expected. They are in expansion zone. They're coming out of the contraction that we have seen. So there is reason to believe that the West is over. However, the Eurozone situation is always somewhat precarious and very uncertain, given the fact that the peripheral nations, although they're staying on top of their budget deficit targets and have shown encouraging growth in the sense that the rate of contraction in countries like Spain and Italy are easing somewhat. Unemployment remains stubbornly high across the Eurozone. There's a lot of disrupted and civil outcry against the current governments in place in Spain and Greece, and the threat of political instability is extremely high. So really all it takes is a civil unrest flare up in, say, Spain or Greece before we start seeing those similar uncertainties creep back into the market, where we may see a possible removal of the government. And it's going to take 5 or 6 years before the Eurozone really starts growing.
Right, Ishaq. Thank you so much for joining us.